Richard Peace Group operates through multiple sectors, each comprising several subsidiaries like Richard Peace Tire Company Limited, Namanukula Plantation PLC, Apico Insurance PLC and Richard Peace Finance Limited. I would like to provide a brief overview of the non-controlling interest and inter-transaction within Richard Peace and Company PLC, looking on two key subsidiaries. Firstly, Apico Insurance PLC holds a non-controlling interest of 18.41%. The non-controlling interest share of accumulated profit stands at 272 million and dividend at 21 million were distributed to minority shareholders, highlighting the sector's contribution to overall profitability. Secondly, we turn in Namanukula Plantation PLC has a non-controlling interest of 32.06%. The company reported revenue of 14.75 billion with 689.65 billion. Attribute to its non-controlling interest, this showcases the plantation segment's importance in contribute to revenue and delivering dividend to minority shareholders. Finally, the group's intersegment activities play a pivotal role in streamlining operations. Shared services such as logistics and raw material supply generated 1.4 billion in intra-segment revenue. Consolidation effort eliminated 6.83 billion in inter-segment transactions, ensuring accurate financial representation.
Welcome to everyone. Our discussion on application of consolidated adjustments. Today we will focus on Richard Peace and Company PLC and its subsidiary Apico Finance PLC. We will aim to explore how consolidated adjustments are essential for accurate financial reporting. Okay, Tarun, can you give us some explanation about financial statements?
Yes, Ingvar. Good financial statements combine the financial result of the parent company and its subsidiaries, a comprehensive view of the entire group's financial position. These statements are essential for stakeholders to assess the overall performance and health of the oil business, ensuring transparency and accountability.
Okay, Tarun. Let's define some key terms related to our discussion from Tarushi.
Okay, Indura. Let's see what are the key terms of related to the consolidation. The first one is what is a parent company. Parent company is an entity that controls one or more subsidiary. And a subsidiary company, it is referred to the another company who controlled by from another company. And another term is a controlling. A controlling refers to the power drawn to the financial and operation policies of the entity. According to all the things, the most important thing is the non-controlling interest representing the equity in the subsidiary not attributed to the parent company.
Okay, Darushi. Now let's discuss some practical application about consolidated adjustments. Yes, it's your turn.
Let's see. What is intergroup transaction? Intergroup transaction refers to financial dealing between the parent's company, Richard Peace, and its subsidiary Apico Finance. For example, if Richard Peace sells goods to Apico Finance, this transaction must be removed from the consolidated financial statement to ensure we only report external revenue, avoiding double counting. Next, adjustment for unrealized profit. If Apico holds inventory purchased from Richard Peace, any profit recognized on that inventory must be eliminated until sold to external parties.
And also, other concept is non-controlling interest. Non-controlling interest should be shown in separately in equity on the consolidated balance sheet. We can get a practical application of this non-controlling interest. We can use the Richard Peace financial statement. In here, you can see how the non-controlling interest reported separately in equity on the consolidated balance sheet. In addition to this is explained in details under the Note 16.
The goodwill consolidation. When the parent acquires the subsidiaries, it must record the goodwill as the difference between the acquisition price and fair value of the net asset acquired, and the adjustment to goodwill. Goodwill should be tested annually for impairment, and if your carried value exceeds its assembled amount, an impairment loss must be recognized. Next, the elimination of intercompany transactions. During consolidation, transaction between parent and the subsidiary must be elimination, avoid double conducting. First one is intercompany sales and purchases and the intercompany profits. The non-controlling interest. The non-controlling interest is reported in the equity section of the consolidated balance sheet and represents the portion of the subsidiaries' net assets attributable to the shareholders other than parent company.
Okay, now let's discuss how these adjustments affect to our financial statements.
Yes, Sindhura, it is important part. In Richard Peary's Company and PLC group income statement, adjustments are made ensure that only external revenue include. This eliminated any internal transaction between subsidiaries, provide a more accurate pictures of company through profit by reflecting only the income generation from external customers. These adjustments help avoid overstarting the company performance and give a clear view of its profitability.
Yes, Samanthi, if you look at the balance sheet, subsidiary assets are added totaling 92.9 billion with intercompany transaction removed. Equity shows parent share and separate non-controlling interest. Intercompany debit are excluded for clear group position.
As the group's overall financial performance, incorporating all subsidiaries, key adjustments including eliminating intercompany transactions, accounting for minority interest and addressing unrealized profit, ensure accuracy by avoiding duplication and recognizing only actual profits. These adjustments enhance the reliability of the statements, providing a clearer view of assets, liabilities and cash flow for informed decision making.
As the end of our discussion, I would like to know some recommendation from Himaya.
Okay, Indora, as a recommendation to enhance financial reporting, Richard Peary's and Company PLC should implement robust internal control for accurate reporting, conduct regular training for accounting staff on consolidation practices, invest in accounting software to automate consolidation process, schedule to period review of subsidiary performance to assess profitability impacts, improve communication with stakeholders about the effects of consolidation adjustments.
Thank you all for your thoughtful discussion today. We hope this discussion has clarified the importance of consolidation adjustments. Thank you very much all.